Imagine you want to control a massive $100,000 asset, but you don't actually need $100,000. What if you could lock down that entire property for just $2,000? And no matter what goes wrong, the absolute most you could ever lose is that initial $2,000. Well, that might sound like a late-night infomercial pitch. This is a standard contract used across the financial world every single day. Here is how it works. One person pays a small upfront fee to get the right to buy or sell something at a specific, locked-in price. Crucially, you can choose to use that right, but you are never forced to follow through. Now think about the person on the other side of that trade. By accepting your upfront cash, they take on the strict obligation to honor the deal if you decide you want to move forward. Options work as straightforward agreements that separate the choice to act from the obligation to follow through. This visual breaks down an example you've probably seen in the real world. You find an asset, say a house, that you want to buy for $100,000. You need 30 days to pull your financing together, but you don't want someone else to swoop in and buy it while you wait. So you make a deal. You hand the owner $2,000 in cash today. In return, they guarantee that for the next 30 days, no matter what happens, you have the exclusive right to buy that house for exactly $100,000. The owner is now legally bound to sell you that property at that exact price. You, however, can walk away at any time. Your maximum possible risk is completely capped at that $2,000 fee. Fast forward 2 weeks. Good news hits the neighborhood, and the open market value of that exact house shoots up to $130,000. You happily exercise your right. You buy the house for your locked-in price of $100,000, instantly capturing $30,000 in equity. Subtract your initial $2,000 fee, leaving you with a pure $28,000 profit. Now, let's reset the board. What if bad news hits instead? A sinkhole opens up down the street, and the house's value crashes to $80,000. Because you have no obligation to buy, you simply walk away. You lose your $2,000 fee. The traditional buyer who bought outright at $100,000 is sitting on a massive $20,000 loss. Finally, there's the flat scenario. 30 days pass and the house hasn't moved a penny from $100,000. There is no reason to exercise your right, so the timer runs out and your $2,000 fee expires. Accepting that $2,000 loss in the bad and flat scenarios is a calculated feature of the design. It is the cost of having a choice, keeping your cash free, and perfectly defining your downside risk from day one. This graphic breaks down exactly how the financial world labels this process. That initial $2,000 fee you paid to secure the right is called the premium. The agreed-upon target of $100,000, the price you locked in regardless of the actual market, is called the strike price. And that strict 30-day deadline where your right to buy disappears is called the expiration date. If you can understand buying a house, you already understand how this works. Financial jargon acts as a set of labels pasted over highly logical, everyday human transactions. Now we apply those exact mechanics to the stock market, where this structure is executed millions of times a day. This diagram maps out our new scenario. Instead of a house, imagine a stock currently trading at $100. You pay a $2 premium per share. Because a standard contract covers 100 shares, your total upfront fee is $200 to lock in your right for 30 days. If that stock rockets to $130, you exercise your right. You capture $3,000 in upward movement, subtract your $200 fee, and walk away with a net profit of $2,800. But if the stock plunges to $70, you walk away. A traditional investor who bought the shares outright is staring at a painful $3,000 loss, while your damage is contained entirely to that $200 premium. By swapping the underlying asset from real estate to the stock market, traders achieve incredible leverage. You control large amounts of stock with tiny amounts of capital, all while perfectly defining your maximum risk before you ever enter the trade. This graphic shows the final two pieces of vocabulary you need. The structure we just walked through, where you secure the right to buy an asset because you expect the price to go up, is officially named a call option. The exact opposite is a put option. This gives you the right to sell an asset at a locked-in price. It functions exactly like an insurance policy for your car, protecting you if the market crashes. People typically use these contracts for 3 specific reasons. The first is investing on price changes. This is what we saw in the stock example, utilizing leverage to control massive assets with very little cash. The second reason is income. Instead of buying the contract, you act like the owner of that house. You take the opposite side of the trade, taking on the obligation in order to continually collect those premium fees. The third reason is protection. By purchasing put options, you create a safety net for a stock portfolio you already own, guaranteeing an exit price if things go wrong. Once you clear away the terminology, these are simply versatile tools for managing risk and leverage. Next, we'll look at the actual mechanics of a live market and learn exactly how to read an options chain.